You think Federal Reserve independence is bad? Just wait and see what happens when they lose that independence and become controlled directly by the Treasury, because that's what the current administration is currently hinting at as their future plan if the Fed doesn't start playing ball. I'm Joe Brown, this is Heresy Financial, and this is a giant caterpillar on my face. Despite how the Federal Reserve may have started, today it exists only because Congress allows it to exist for their own purposes. The Federal Reserve Act was amended in the 1970s, and the Fed was given 3 mandates: maximum employment, stable prices, and moderate long-term interest rates. Those 3 mandates may sound benign, but they are all there to serve the government's purpose of infinitely increasing its spending power. Because with a population that is maximally employed, the government gets maximum tax revenue. With prices that are always steadily increasing instead of the natural deflation we would get without the Federal Reserve's intervention, you have inflation that keeps people spending and borrowing more, keeps people employed for longer, and allows the government to borrow below the rate of inflation. But the big kicker is this third mandate, which most people are not aware of, which is moderate long-term interest rates. In other words, it is the Federal Reserve's job to make sure that all of the spending the government wants to do past its tax revenue that they have to borrow for doesn't get too expensive. And that when interest rates on something like the 10-year Treasury get too high, it is the Federal Reserve's job to get that lower. Now, right now, the Federal Reserve is not playing ball with this specific mandate. In other words, right now, the Federal Reserve is doing something called quantitative tightening, which is actively letting government bonds roll off of its balance sheet. That makes government borrowing more expensive. They're also keeping interest rates high, not cutting despite the fact the administration wants them to, which is also making government borrowing more expensive and more difficult. Now, if left alone, continued on this path, that should force the government into austerity, meaning they're gonna have to pay the bills some way, which means they just have to cut the spending. But given the fact that taxes have been cut and spending has just been committed to be a lot higher because of the one big beautiful bill being passed, that's not an option for the government. And partly as a result of this, the Bloomberg Government Bond Liquidity Index is at the worst place it's been since the data has been recorded. This is an index that measures liquidity available for trading government bonds, and the higher it is, the worse the liquidity is. And you can see it has never been this bad before, even during the great financial crisis. This is the reason why the administration wants interest rates to be lowered so badly. It's why Trump keeps posting about too late Powell, calling him names, and looking for ways to fire him and get rid of him. Because despite all of the flaws, and there are many with the Federal Reserve, keeping rates higher right now instead of lower and continuing with QT instead of QE right now is healthier in the long run than the opposite. The stock market is literally at all-time highs right now. This is not the reason why the administration wants rates lower. It's strictly because the US government is running out of dollars to borrow. Liquidity in the financial system has dried up, and with taxes cut, spending higher, the only thing they can do is borrow. But all of the debt that they are currently rolling over, plus all the new borrowing they have to do, means there's just not enough money out there for them to borrow the amount that they want, especially with the cost of their current debt. But like I showed you before, the Federal Reserve exists only because the government wants them to, because the Fed serves the government's purposes by helping them spend an infinitely higher amount of money. The Federal Reserve Act that brought the Fed into existence has changed in the past, like it did when they were given their, what they call the dual mandate. It's really a triple mandate, and it can change again. Now, recently, the Treasury Secretary Scott Bessent went on CNBC to talk specifically about why the Federal Reserve may need a change. Again, hinting at future control, more oversight, closer coordination between the government and the Fed. Now, I cannot play the video for you because of recent changes in YouTube policy, but these are some of the statements Bessent recently made in this interview. Number 1, we need to examine the entire Federal Reserve institution and whether or not they have been successful at their mission. Number 2, if this were the FAA and they had this many mistakes, we would take a look at what was going on. Number 3, they have all these PhDs over there. I don't know what they do. Number 4, the Federal Reserve is like universal basic income for academic economists. Now, pretty much everything he said here is true. They're the largest employer of economic PhDs. They make tons of mistakes, and they absolutely should be examined. However, not for the purposes being implied here. In other words, he's saying, hey, they should be lowering interest rates, and instead they're spending billions of dollars on renovations and keeping rates too high for the rest of us. But it's not just Scott Bessent hinting at future changes and closer coordination between the Fed and the Treasury. Kevin Warsh recently talked about needing regime change at the Fed and called for a deeper partnership with the Treasury. Kevin Warsh is a former Federal Reserve governor, and he is allegedly on President Trump's shortlist to lead the Fed if and when they can remove Powell. He said, we need a regime change in the conduct of policy. He said the credibility deficit lies with the incumbents that are at the Fed. Warsh has made multiple sentiments in line with what Trump wants from the Fed. In other words, cutting rates and maybe even restarting QE. Warsh said that their hesitancy to cut rates is actually quite a mark against them. He said he thinks that the specter of the miss that they made on inflation has stuck with them, which may be a reason why they're keeping rates so high for so long. Now, all of that is fairly benign, basically saying, hey, we need somebody to go in and make monetary policy more loose because that's what the administration wants. He's saying those things so that he's maybe in a better position to get that job. But what he says next is a little bit less benign. We need a new Treasury Fed accord like we did in 1951 after another period where we built up our nation's debt and we were stuck with a central bank that was working at cross purposes with the Treasury. That's the state of things now. So if we have a new accord, then the Fed chair and the Treasury secretary can describe to markets plainly and with deliberation, this is our objective for the size of the Fed's balance sheet. This is huge. You don't even have to read between the lines here. Basically, what he's saying is go back to what happened directly after World War II. What you will see is at the peak, the government's debt to GDP ratio hit 120%. The government needed to deleverage. They needed to get their total debt smaller compared to the size of the economy. You can see from this chart, they were successful over the next 40 years. The debt to GDP ratio did fall to about 30%. If you're unfamiliar with this, this is a long-term debt cycle. You see after that, the debt to GDP ratio rose again. But the question is, how did they do this? And one of the main tools used for this was yield curve control from 1942 through 1951. Yield curve control is like quantitative easing on steroids. QE is where the Federal Reserve purchases treasuries from the open market. Now, they have a specific number of treasuries that they choose to buy. That's how they operate QE. They say, right now, we're going to be buying this many treasuries per month. Now, that is going to add demand to treasuries, but there's other factors, other supply and demand, other players in the market that will also dictate how much those treasuries cost and what the interest rates therefore are. So they're a player that enters the game to influence the price, but not directly control it. Yield curve control is like QE on steroids. In other words, the Federal Reserve comes in and says, we want to peg the interest rate at a very specific range. So they'll look at something like the US 10-year Treasury and they'll say, instead of it being at 4.3%, we want it at 2.5% or 2%. The only way to accomplish that is to commit to a potentially infinite amount of buying of those treasuries. They say we will buy as many as needed to make sure the price is pegged here. It would be like if Apple came out and said, we want all used iPhones to be exactly $1,000 when they're selling in the open market, like on eBay and stuff. Well, the only way to make sure that the price of used iPhones never goes below $1,000 is for Apple to commit to buying any and all used iPhones for a minimum of $1,000. Now, they could go higher than that because let's say there's just a huge amount of demand for those iPhones and people are buying them for $1,100 instead of letting Apple buy them for $1,000, but there would be a floor there. In the same way, the Fed would commit to buying enough treasuries so that the price of those treasuries doesn't fall enough to get those rates up higher than they want them. The effect of that is that the government is then able to borrow an infinite amount of money at those lower rates, which are going to be lower than the rate of inflation. As a result of that, nominal economic growth happens, the size of the economy gets larger, and the cost of that pile of debt for the government gets lower relative to the size of the economy, which fixes the debt to GDP ratio. In other words, the government forces the Fed to help them print money into existence to print away the debt problem. It's inflationary financing. Now, don't get me wrong. It works for the government. But you also see during this time frame, interest rates rose for everybody else. And so did prices of goods and services and assets. In effect, the government offloads the cost of its debt onto the economy. We pay for it with higher interest rates on our debt and higher prices of goods and services and assets. And as you can see, the debt to GDP ratio has hit 120% yet again, which means the phase of the long-term debt cycle that has been going on from 1980 through 2020 is over now. And we have entered a new phase which will look much more similar to 1940s through 1980, because the government is going to be employing all the same tools they did before in order to reduce their debt to GDP ratio, just like they did last time we were here. One of those is yield curve control, which is quantitative easing on steroids. And the only way they do that is if the Federal Reserve plays ball and enters into a very deep, close coordinated partnership with the Treasury. Occasionally I'd get people in my comments saying, hey, it's Mr. Doom and Gloom predicting another crash and another recession for years in a row. That's not what's happening here, just to be clear. When the US government prints money in order to inflate away its debt, you don't get a depression. You get crack up booms, you get asset price inflation, and ultimately you get a wealth transfer from the poor, from the savers, from the wage earners to the politically connected and the asset holders, the rich. So if you are not positioned to take advantage of this, not only are you going to be left behind, but you'll be left in a much worse spot. You need to have your assets allocated properly, the right amount in gold, which by the way, you couldn't do during the 40s and the 50s last time they were doing this. You can protect yourself now by buying things like gold. You can protect yourself now by buying things like Bitcoin. You can protect yourself very easily by buying some index funds, properly allocated to the different sectors that are receiving most of the money that is entering into the economy. If you don't know how to do this and protect yourself from the volatility along the way, I've designed a step-by-step plan for you. It's called the Hyper-Growth Portfolio Blueprint, and it is exactly what you need to make it through the next couple of years, not only protected, but profit handsomely from it. I've got it on sale for you right now. It's linked in the description below. As always, thank you so much for watching. Have a great day.